Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And before we begin, I just want to wish everyone an absolutely fun and safe and happy July 4th long weekend. You know, we're certainly as Americans, we could not be luckier to be living in the greatest country in the history of humanity. And no matter what's going on in the world, we're certainly lucky to be living in this great country. And so please, everyone, have a great long weekend. Now, as it relates to the market, we had that down week as it relates to the S&P 500, the Dow Jones, and certainly across overseas there in Europe as well. The good news is divergences are continuing to play out. Now, everything broadly saw a bit of a pullback this week. We had two big weeks, especially for those secular growth stocks underneath the hood of the market. So, every once in a while, you want to get a little bit of a healthy pullback as we're coming off what we call the neighborhood or the vicinity of a bottom. And we continue to see some of that healthy action play out this week. So the title of this week's presentation is called Healthy for Growth, or Hungry for Growth, I should say. Now, why is that? We believe that the markets right now are migrating from what we call fearing inflation. So in that type of market, stocks that don't do well with rising interest rates or rising prices, such as secular growth stocks, those get hit really bad. Now the market is starting to transition to one that is fearing a slowdown in growth. So in other words, cyclical economically sensitive stocks, such as are often pervasive in the value sector of the market, they historically don't do very well in this type of market, versus those companies that can grow in a low growth environment, they tend to do pretty well because they're hard to find and investors are willing to pay a higher price to have access to those types of companies. So that's the type of characteristic we think is starting to play out here in this type of market. So three things we're going to cover this week. What we think needs to happen for investors to be able to unlock value in certain parts of the market, such as secular growth. Number two, are there companies out there that can deliver growth in a low growth world? And we talked a little bit about that just now. We're going to go deeper into that. And then lastly, what is our view on the state of inflation and economic growth? Now, as we talked about, markets are in transition. So if we kind of think the beginning of the year, inflation was like that real big concern, and growth wasn't a concern at all. In fact, growth was part of the problem. The economy was growing way too hot, 6, 7, 8% GDP prints. Those were emblematic of an economy that was overheated. And the way I always like to describe inflation and economic growth is when growth is getting too hot, it's like that pot of boiling water. And when you let it boil for too long, it overflows, and that's inflation. So right now we're in that process, thanks to the Federal Reserve, of cooling down growth. And as growth cools down, that overflowing pot starts to take care of itself and no longer is overflowing. And so right now we've gone from where inflation is way up here, growth concerns are way down here, non-existent, to suddenly we're getting closer to equilibrium, where there's this big tug of war between, am I worried about inflation? Am I worried about growth? And slowly the concerns around growth are taking control. And what does that mean? We have to adjust our playbook, right? So from what works to offsetting rising inflationary pressures to what works in a world looking for growth where there is not a lot of growth. So that's how we have to look at our overall investment playbook going forward. Now, the good news about that is that that's really what we thought was going to play out in January. The whole thesis around slowing growth and slowing inflation got delayed because of that war in the Ukraine. It's now starting to play out. 4 months late on that, but better late than never is the way we sort of like to look at the world. Now, growth in a growth-starved world. As growth slows down, investors historically often pay more for those areas that can deliver high growth in a low growth world. So in other words, if you have a company that can grow 20% while GDP is growing 0 to 1%, I'm going to pay a lot more for that company during low growth than in a high growth world where lots of companies are growing 20%, right? So those valuations expand for those secular growth companies in that sort of flatlining growth type of world. Now, there's three key areas right now that we see that are starting to act better from a relative strength standpoint, in other words, acting better relative to the S&P 500, and from an absolute price perspective, in other words, the market's coming down, but these stocks and sectors are actually starting to move upward in price. The first is China. The Chinese stocks related to the China recovery as that country reopens. We're seeing a lot of positive price action there. The fundamentals are fantastic. The valuations are incredibly cheap for high growth companies over in that country. And quite frankly, that entire sector is hated right now by most global investors, as the last 2 years have been pretty rough over there. Number two, biotech and healthcare. Healthcare has been leadership for most of the year, and it's actually, from a relative strength standpoint, moving on to new highs. But biotech is emerging after a deep downturn where that sector itself was down north of 60%. Lastly, cloud computing. We know that cloud computing stocks peaked out in around February of 2021 as valuations started to compress with rising inflation and rising interest rates. It's often the case in the stock market that the first areas that are shot are often the first areas that start to recover. So from a RS standpoint, a relative strength standpoint, we've started to see some of these high quality secular growing names within cloud computing start to put in higher lows and higher highs off those bottoms in mid to late May, right? When the market hit new lows in June, these areas, all three of these areas in general, as a group, did not hit new lows. And in fact, they hit a higher low and began to rally to higher highs. Even on a day like today, Friday, when the market was generally weak for most of the day, these areas were green. So we're continuing to zero in and focus on these three key areas of improving strength in this bear market. So how do we unlock value? So first, the thing that really needs to happen for these areas to really accelerate to the upside is for some of the overall macro headwinds to die down. Believe it or not, bad news for the economy right now is good news for us. As the economy slows and demand continues to slow, and as the data confirms that thesis, you generally are going to see rates start to back off, and then people are going to get more confident that the Federal Reserve doesn't have to hike rates as fast or as much as previously thought that would otherwise kill the economy. And they'll start to chip away at companies that will grow in a low growth environment. Number two, we need to see inflation peaking. We saw the PCE data this week. We saw early signs and continued signs that late March and April and early May, in that time period, was generally so far in the short term showing signs of peaking inflation. And lastly, China recovering. China's the second largest economy in the world. They've been shut down on and off for the last 2 years. So the more that China can recover, the more that global growth can find a good anchor, because we know that US growth has been strong for a while. It's slowing down. We need another country to pick up the pace. So what better country than the number 2 economy in the world to offset the US slowdown? So where are we in this process? The good news is US growth is definitely slowing. We see it as it relates to employment growth. We see it as it relates to ISM manufacturing. So the level of manufacturing activities slowed sharply in the report that came out today. In fact, new orders on manufacturing went below 50, and 50 is that dividing line between expansion and contraction. So the fact that we're in contraction mode within new orders of manufacturing activity is A, great if you're looking for slowing growth, and 2, it's disinflationary. We want disinflationary forces to come in so that we don't have to raise interest rates as much in 2023. 2022 is already in the books, ladies and gentlemen. It's 2023 that the market is moving on at this point. So we see here the real-time GDP estimates out of the Atlanta Fed has continued to move lower and actually in somewhat negative territory right now. So we want to see that. that's disinflationary as it relates to the inflation problem. That's what we want to tackle. Number two, China. Picture says 1,000 words. We look at those PMIs, those ISM data. In other words, these are activity indicators, whether it's Chinese manufacturing or the services and consumer spending. Sharp upward acceleration in China. One thing you need to know about ISM data, it has the strongest positive forward returns when ISM is deeply below 50. In other words, high 30s, low 40s. And that's kind of where that Chinese data bottomed out at in early March. So kind of plays to that tune. When things are deeply negative, you could lean in and you buy into those areas, and China fits the bill across the board there. Now, as it relates to inflation, the Fed's two favorite measures of inflation are the PCE data, which came out on Thursday, measures a lot of those consumer price indices. We see their core PCE when you strip out the impact of food and gas. And I know that people hate when they hear Wall Street talk about stripping out food and gas, but this is what the Fed uses to gauge interest rate policy. We see, again, this is rolling over. It's still too high, but it's rolling over. It's about the rate of change, that second derivative that really impacts how asset allocation works and how stocks start to move. Number two is what we call the 5-year forward break even. So think of, what do we think inflation is going to be in 5 years? Then at year 5, what do we think inflation is going to be in 5 years after 5 years? That's what the Fed looks at, because that's what we call long-term inflation expectations, and the Fed doesn't want that to get anchored. As soon as that gets anchored, it's a lot harder to get rid of inflation. Now, the good news is this peaked in March, and we've had this very strong rollover as it relates to the headline 5-year forward break even on inflation. So let's look at the high frequency charts, right? So in other words, it's great that we get these reports, but we're kind of looking in the past, right? I mean, who cares what inflation did in May or in April? We're living in the now, we're living in the future as it relates to our investments. So what is that high frequency data telling us? So when we look at the supply chain, and by the way, the supply chain is the big problem here. Don't let anyone else tell you anything different. The supply chain is the big problem as it relates to inflation. Shipping rates from Shanghai to LA are starting to plunge. We want to get back into this normalized era pre-COVID. So we still got some work to do, but we're going in the right direction, and strongly so. We are expunging COVID from the global supply chain. Number two, that commodity shock that we talked about last week is now becoming a downward shock, right? So since the peak, lumber is down 54%, oil is down 14%, natural gas is down 40%. If you're starting to see those high utility bills, help is on the way. Natural gas is down 40% off its peak. Cotton down 34%. Get ready to see some discounts at your local clothing outlet. And copper is down 25%. Again, further evidence that the economy is slowing down. And we see it in rate expectations. So this chart seems a little bit complicated, but basically what this chart is telling us is that investors were expecting rates to increase after 2022. Okay, so what are we expecting rates to do from December of 2022 to December of 2024? A few months ago, investors were expecting almost 4 rate increases in that time period. Look what's happened over the last few months. Investors are now expecting rate cuts between December of this year and December of 2024. So what does that mean? We have to skate to where the puck is going. What works when interest rates drop? Leave this whole world of interest rates going up and the Fed increasing 75 basis points in July. It's going to happen, but that's not what's going to move the market. What's going to move the market is what happens next, what happens after that, because that's already priced in. What happens after December? And right now, expectations, believe it or not, are for rates to drop in 2023. That's what we have to pay attention to. So the bottom line, ladies and gentlemen, is that growth and inflation are beginning to slow in the US. We want to focus on companies that can grow in a low growth environment. Right now, the three key areas that we are zeroed in on: China, healthcare and biotech, and cloud computing software names. Those are the three key areas that we're heavily focused on. So we do think growth concerns are going to begin to outweigh inflation. That's good for us. Commodities, they're out the tank right now. They're collapsing. That's good. We want to see those disinflationary forces pick up steam. And as I said before, China, biotech, software, the three keys, I think, to this market and making money in this market over the next 6 months. Thank you again. Have an incredible Independence Day holiday. We all deserve it. And certainly we could not be more lucky to live in the greatest country in the world, in history. Thank you again, and have a great Independence Day weekend.